All right, we're going to go ahead and get started here. Welcome to the Arrive Private Credit Fund webinar. Our speakers for today are Ryan Frazier, our CEO and co-founder, Cameron Wu, our VP of Investments, and then my name is Corinne Headland, and I lead our investor relations team here at Arrive. A quick disclosure and reminder for all, this is not a research report or investment advice. All opinions expressed in this webinar are those of our presenters, and past performance is not indicative of future results. A light agenda, so you all are aligned on expectations for today. We'll be walking through Arrived offerings, what we currently offer, the private credit fund, which is live now. Ryan will be actually walking through a live demo so you all can see it up close and personal. Cameron will walk through real estate debt versus equity, Arrive's work and expectations, and then we'll move to Q&A. So for folks that this might be your first webinar, feel free to drop any questions that you have in chat. Myself and our team will either answer in chat or tee them up for live answering after prepared remarks. Again, the questions for today will be hyper-focused on the private credit fund. Otherwise, we host our Intro to Arrived webinars 2 times per week. All right, I would love to welcome Ryan up to the stage, and I will catch you all at the end.
All right, thanks, Corinne, for the introduction, and thanks everyone for being here with us today. To start, I want to talk a little bit about Arrive's offerings. With Arrive, we offer multiple ways to invest in single-family homes. Starting with individual properties, we make it easy for investors to choose which properties they want to invest in and have control of exactly how they want to build their portfolios. With the single-family residential fund, we allow investors to invest in a diversified portfolio of properties that our professional investments team manages on their behalf. And then now with the private credit fund, we're giving investors the opportunity to invest in a fund that finances professional real estate projects. These represent things like new home construction or full home renovation performed by real estate professionals. And with interest rates at their highest point in over a decade, we believe now is the right time to introduce the private credit fund with residential real estate as the asset backing. We believe that the increased interest rates alongside a housing market with limited supply can provide investors with strong returns and with downside protection. But we're not the only ones thinking about this. The private credit market is a $2 trillion market and one of the fastest growing investment classes right now. The challenge for investors has been that minimum investment sizes are often 6 or 7 figures, and portfolio managers often mix asset classes, which can make it challenging to know what you're investing in. And one of the reasons at Arrive that we've been really believe so strongly in residential real estate is just that it's been so undersupply by millions of properties for the last 10 years. And this means that really in the event of any borrower challenges, there's a robust market of housing demand for these properties that are being financed. And so we believe that will provide additional downside protection for investors who participate in private credit backed by residential properties. We also believe that private credit can play a crucial role in adding to the supply by financing new homes being added to the market. And so with all of that in mind, today we're excited to launch the Arrive Private Credit Fund, available to everyone. And the Arrive Private Credit Fund will invest in financing professional residential real estate projects. These are short-term loans for projects like new home construction or redevelopment. And the average loan term will be between 6 to 36 months. And we anticipate that individual loan sizes may range between $100,000 to $500,000, but we'll evaluate loan opportunities up to $5 million right now. And to share a few quick highlights for the private credit fund, first, this is a yield-focused real estate fund, targeting dividend yields 2 to 3% above short-term treasury rates right now. And that means current dividend yields should be between 7 to 9%. The fund assets are secured by residential properties as collateral and personal guarantees. And in the event of any individual borrower default, that means that the fund can take possession of the underlying properties. And last, the fund will offer access to liquidity on a quarterly basis after the first 6 months. This is the same liquidity program that also supports our single family residential fund. And we're excited to launch this product today. So now let's take a quick look at where to find the Arrive Private Credit Fund on our website or our app and what information is available. So give me one moment just to switch over to share my screen here. All right, so I'm just pulling up the Arrive website, and you can find the Arrive Private Credit Fund by clicking on the Invest page. You'll see that today we've launched the Private Credit Fund, and it'll be available on the Invest tab or the All tab, also under Real Estate Debt as an investment category that we've added. If I click on the Private Credit Fund, you can see the information that's available for investors. We'll introduce a bit of the investment or about the fund and the investment strategy. We also have a video just explaining that investment strategy for investors and some of the benefits associated with investing in private credit. And then also how to think about returns that are generated from investing in real estate backed debt, the source of those returns, how it's generating cash flow, and what the expenses of operating the private credit fund look like, and then what the ultimate net potential return for investors are. We also address a few common questions on the page that we anticipate investors might be interested in, but we also have a help center, a learning blog where investors can get more information as well. There's also a few different tabs to get more information on the private credit fund. There are details about the offering, things like the liquidity program that we introduced and the fees for managing the private credit fund. And then for any investors that are new to investing in real estate backed debt, there's an intro to debt tab. And this goes into a little bit of what to think about when investing in real estate backed debt, how to compare real estate debt to real estate backed equity investments, and then how to think about these different types of investments in the capital stack. So that's a little bit of an overview. We hope that you'll check out the private credit fund tab, and we're excited to hear what questions that you have, what feedback that you have, either through the Q&A today or also just reaching out directly. So with that, I will take a pause. I'll go back to our prepared remarks here, and then I will introduce Cameron to join me and go into a bit more detail on the private credit fund. Thank you.
Righty. Thank you, Ryan. Thanks for joining today, everyone. We are very excited to debut our private credit fund. So I'm going to go through the profile of our target residential bridge loans. So we'll describe what role does credit play in the real estate industry, what types of loans we're specifically buying, who are the key parties in a loan, like what roles do they play. We're going to talk about the mechanics and features of the loans that we will be purchasing into the credit fund. And we'll talk about underwriting and risk management. So how do we select the loans? How do we mitigate that risk? Okay, so first, what does credit provide in the real estate industry? And really what credit is that it's a productive use of capital to help projects go and really accelerate the value add that is produced in the real estate industry. So first, before we get into real estate credit, let's just think about a credit card, something that most people are pretty familiar with. So what a credit card allows you to do is buy goods and services in the moment, and then throughout the month, you are earning your paychecks and making money yourself, and you're generating the income to later pay it back. So it allows you to pull forward that usage of capital on whatever that it is that you need, and then pay it back over time. So real estate loans are the exact same productive use of that capital. You think about purchasing a property, the renovations involved, all of the closing costs, and it's a pretty big chunk of money. So to accelerate the usage of it, people borrow money so that way they can fix houses, flip them, sell them, and then introduce new supply into the housing market. So that's really what the short-term residential bridge loans provide, is that capital for entrepreneurs and developers to really produce the real estate projects. So what is it? It's a promise to pay for the use of money. So this isn't equity. This isn't not an ownership stake like owning a rental, owning a vacation rental. So it's a little bit different, but there is the promise to repay. And all of the loans that we are purchasing are going to be in first position, which means that the security that is securing the promise to repay that will be the first to be satisfied. Second, it bridges you from one point to another. So you may be investing in a property as an entrepreneur or a developer that needs a lot of rehabilitation. So that money helps you get from point A, which is a house needing a lot of love and a lot of fixing, to point B, which is something that is marketable on the MLS or in the real estate market. Okay, now who's involved in a loan and what role do they play? So first you have a borrower. You have the entrepreneur who sees a project and sees the ability to create some value, but they need some capital. So they would go to an originator. Now, originators are the groups or the lenders that are typically making that extension of credit. So the decision of what amount that they will lend, what is the interest rate, how many points you have to pay, how long will the loan be outstanding. They make that extension of credit based on your experience, your credit score, and the assets that you have backing the project. Then there's the creditor. So this is where Arrived comes in and the private credit fund. So by purchasing the loans, even though Arrived does not act as the originator, making that original extension of credit to the borrower, Arrived Private Credit Fund will be the creditor because they're the one who's really putting out the money to be able to lend to the borrower. So originators and creditors can often be the same party. As an originator, plenty of them hold those loans on their own balance sheets and books and then collect the interest themselves. But a lot of times they are separate entities. So Arrived is partnering with a few select originators to vet all of the loans and the borrowers that we will be purchasing into the private credit fund. And then we serve as the creditors. Then once those loans are purchased in, then there's a servicer involved. The servicer is the intermediary between the borrower and the creditor. So they will collect the payments from the borrower and then distribute it to the creditor. Now, for one loan, seems simple. Why would you need a servicer necessarily? And that's probably fair. But on the scale of a credit fund, you would have potentially hundreds of loans that are going to be in the same credit fund. So servicers really help keep track of every single loan, all of the interest payments, all of the principal, any sort of construction draws that are required throughout the process. The servicer is receiving that information to provide the detailed accounting for money that is owed and whether it be interest or additional principal. Okay, so now let's go into the mechanics of a loan. So first, the economics. What kind of rates do borrowers typically pay? How do originators make money in all this? So typically, your residential bridge loans are going to have a high single digit to a low double digit cost of borrowing. So this is the interest rate that the borrower is paying out to the lender. Originators, they are in the business of collecting points. So if you've ever taken out a mortgage, you'll probably have paid points at some point in that loan. So let's say that you borrow $100,000 and the lender is charging you 2 points. So that 2 points is $2,000 or 2%. And that's money that the originator keeps to service their operations and keep their business going. The ongoing interest payments that are due are going to be paid out to whoever the creditor is. That is, whoever extended the actual money that the borrower is using. Next, short durations. So residential bridge loans typically have a much shorter period than what we're accustomed to with anywhere from a 15 to a 30-year fixed mortgage. So these loans are going to be outstanding for, on average, 6 to 24 months, with probably most loans taking about 9 months. So from the point that they're originated, the borrower then is going to apply for permits, get construction going, and then take various draws, and then finally sell the property once it's ready. And that'll take 9 months to a year, or faster or longer, depending on the scope of the project. Next, it's secured by real estate collateral. So this is what I was referring to earlier when you have a mortgage or a deed of trust. This is the security instrument that says, okay, there is a promise to repay the $100,000 that the borrower borrowed from the creditor. And to secure that promise to repay, we're going to put a mortgage or deed of trust against the property. That will be the security that in the event that the borrower is not able to perform, is not able to repay back, then the lender or the creditor has the right to foreclose on the property. So that is what secures the loan. And then finally, recourse loans. So recourse means that the creditor has recourse against the borrower in the event that the real estate collateral, the home, the project, the piece of land, is not able to satisfy the full repayment. So let's say, for example, the borrower borrowed that $100,000. They were unable to perform for some reason, and then it ended up getting foreclosed upon, and maybe net proceeds were $90,000. So that's not enough to satisfy the full $100,000 that was loaned out to the borrower, but the creditor has recourse against that borrower. So if the security is not enough, then the borrower, you can get a judgment against the borrower to pay you back the full amount with interest, with fees, all included, not just the principal amount. Just want to quickly contrast this with some of the mortgages that have been originated with properties on arrived rental homes or vacation rentals. These are non-recourse. So if you've ever been to our other webinars, we've talked about how our loan program is non-recourse. And that's when arrived is on the equity side of things. So we're taking out mortgages, long-term 30-year mortgages, but they're non-recourse to the entity. So that means that arrived investors could never be held liable for the repayment of the loan on any of the equity instruments or any of the rentals that our investors have invested in. And then to quickly contrast that, these loans for the residential bridge programs and the private credit fund, they would be recourse against the borrower, the developer. So it's a plus to the arrived private credit fund investors in that there's always a borrower who's backing that promise to repay. Okay, so let's go a little bit into underwriting and risk management. So there's a 3-step process for underwriting these loans. First, you want to underwrite the originator. So you want to check out their business processes, make sure that they get credit reports, that they're running background checks, that they're doing verification on the developer's experience or the borrower's experience. After that, you want to focus on the borrower. And arguably, this is the most important component of all, despite people thinking, oh, when you're looking at loans, there's loan to value ratios, there's risk adjusted returns, there's all these different attributes that you would look at with respect to the property and the loan rates. But arguably, the borrower underwriting is the most important because that developer, through a recourse loan obligation, they're really the biggest safety net against performing, because you could have a project that maybe doesn't hit the mark with the market. Maybe the developer was off on their expectations, but if they're credit worthy, if they have other assets to back up their borrowing, then ultimately they have the incentive to not want to default on that one particular loan, because it could impact them negatively going forward on any other sort of credit that they want to take out. So they would be motivated then to pay back with other assets, even if that one particular project or loan did not pan out in the way that they thought it would. Then finally, focus on the property. So when we're underwriting a property, we want to really make sure that there is an appropriate matching between the plan that the developer has and the real estate project, with where it's located. So you don't want to be over improving a house. You don't want to be under improving. You don't want to have $1 million project in a $300,000 neighborhood. Everything has to be proportional, such that you have a good exit. And ultimately, that ability to exit for the developer is going to be the way that the credit fund ultimately gets repaid. So you have a $300,000 neighborhood. Maybe you have a project where you invest $210,000 into a house, $40,000 into rehab, and then you can sell it for $360,000 for a relatively quick exit. That's a great project. You have the right ratios, you have the right target exits, and ultimately that appropriate pairing is going to allow for the successful exit for the developer, such that the private credit fund can get paid back. Okay, so there's 2 example loans. These are actual loans in the private credit fund. And these are some of the attributes of it. So you could have loans, anywhere from $200,000 or even slightly less, all the way up to $1 million, depending on the market. So the $1 million project in example 1, it's actually located in Seattle, Washington. So we finally have a project in Seattle. It's great news for us. We've have a lot of the team here, and we haven't been able to find the right equity investments, and the timing hasn't been right. But with debt and credit investments, it's really a much more diversified pool of opportunities that you have, because ultimately you just need to get paid back. So if the project makes sense, the time horizons are shorter, you're taking a little bit less risk in terms of timing, then you can go into a wider variety of projects. So for example, this $978,000 loan, it's for the rehab of a project in a great neighborhood, plus the addition of an accessory dwelling unit. So they're going to be putting a new construction unit on an existing lot and rehabbing the home. So we thought it was a great project with a 56.7% loan to after repair value. And what that means is that the loan amount relative to the anticipated value of the full project is 56.7% of the value. So roughly you would have a 40% buffer or so for the market to experience volatility, whether it goes up or down. You have that 40% buffer to really protect your principal in the project. Loan example 2, we have a great entrepreneur who's done a lot of different real estate projects, so 20 in the last 3 years, a 70% loan to after repair value, which is very common. So for example, if you had that project where the end value was anticipated to be $100,000, then the loan would be $70,000 at max. So loan type, it's a rehab, and it's in Columbus, Ohio. So even with our first couple of loans within the credit fund, we have a nice variety of different locations, different project types, and different loan points to help diversify the credit fund. And lastly, let's talk a little bit about the private credit fund process. So investors, much like the single family residential fund, you buy shares of that credit fund, and maybe most close analogy is something like a mutual fund where you're just buying shares of that credit fund. And as the credit fund grows, then your exposure keeps growing too to various assets as it gets larger. Then Arrive takes that money and purchases the residential bridge loans that I just went over time. So for that 9 months on average, the borrower is paying the private credit fund the interest payments, and we're receiving those payments from the servicer. So investors receive those monthly dividends on a monthly basis. So much like all of our individual property offerings and our SFR fund and all of our equity products, investors will receive those dividend payments that are supported by the interest payments on that monthly basis. And as we receive all of those interest payments, 100% of that is getting paid out, less the credit reserve that we have. And then finally, when the borrower pays back the loan and has a successful exit, then we take that principal money and then reinvest it into other loans. So it's a pretty active process, right? It's a little bit different than holding on to equity where you're in it for that 5 to 7 year hold period, waiting for the appreciation. With residential loans, there's no expectation of appreciation. We're not trading loans, we're holding them to maturity. But when they do get paid back in full with the principal, then we'll just keep reinvesting it. So as it grows, then we'll have a larger and larger pool of dollars to keep reinvesting into different projects. And then you'll keep getting those interest payments on that monthly basis. So that describes the flow of how money comes in, values generated, and then distributions get paid out and then recycled back into other loans. And yeah, that's the end of our prepared remarks. So at this point, I'll invite Corinne and Ryan back onto the stage, and we'll take any and all questions you may have.
Cameron and Ryan, thank you so much for prepared remarks. Seeing lots of fantastic questions come through in the chat, which we're very excited about. Saw a lot of our Arrive team also answering those. If we don't answer directly your question, know that we're grouping themes on our end, but keep us honest in the chat if we missed any. All right, let's go ahead and get this started. The first one is from Lee. This is a new investment opportunity. It seems to be predicted to have high interest rates. When interest eventually drops, what will happen to this fund? Cameron, I will kick this first one to you.
Yeah. So when we're talking about interest rates dropping, we're typically looking at a yield curve that is reflective of kind of government and Fed bonds. So you could have short overnights rates. So you may have heard of the term LIBOR or SOFR. Those are overnight rates. And then you also have 2-year treasuries, 10-year treasuries, and 30-year treasuries, right? So those are all government agency yields, and they have a profound impact on all investments, right? Now, with residential bridge loans, over at least the last 15 or 20 years that I've been tracking this market, interest rates are a little bit decoupled from the movement of the federal curve. So to the extent that interest rates come down on overnight rates on treasury yields, like we have seen them, It's possible that interest rates would slightly come down on this market as well. But in general, we've seen a pretty stable level of borrower interest rates within the residential bridge sector. So we anticipate that interest rates will come down, on that yield curve. But more or less, we're expecting the interest rates for the borrowers to remain relatively stable.
Fantastic. Cameron, thanks for walking through it. Lee, let us know if there's any color needed there. This next one is from Derek. For the expected loan portfolio, what percentage will be comprised of floating rate loans versus fixed rate loans? Cameron, perhaps you start on this one, then Ryan, if you have any color as well.
Yep. So these loans are typically fixed rate loans. They're also shorter term in duration. So there's also less interest rate exposure. So you can imagine that, let's say in a world where you originate a loan and the borrower is paying 9.5%, then even if interest rates went up a lot and you may be thinking like, ooh, missed out on the opportunity to get even more interest, the duration of those loans is pretty short term. So the actual impact on the change in value, your opportunity cost is not that high. Additionally, we're buying loans all the time. So even if interest rates do move, then that one particular loan is only a small percentage of the total overall portfolio. So to my knowledge, all of these residential loans are fixed rate loans. I've never seen a floating rate short-term residential loan. But, to extend that further, because of that short duration, there's very minimal impact in the opportunity cost sense.
Fantastic. All right, moving back over to the chat. I did see about 5 or 6 questions regarding if there's going to be a recording. Absolutely. We'll be sure to send a recording out to all registrants here today, and it will also be on our webinar landing page in a whole host of different places. So we'll be sure to send that out if you were late or would like to view it at a different time. All right, this one is from William. What is the interest rate tied to? Do you expect the rates to move below 7% or above 9%? Cameron, I'll kick that one to you as well.
Yep. So the interest rates are directly tied to the promissory notes that the borrowers are issuing at the time that they borrow the money. So I saw a quick question in there. What do we mean by short term? So typically 6 to 24 months, with the average being around 9 to 12 or so. As far as the aggregate, what do we expect interest rates to move below 7, above 9? We expect it to stay pretty steady in that range. Call it an average of around 8%, regardless of how the interest rates move with respect to government treasuries. But, because we're always constantly buying loans, we'll always have the opportunity to rebalance, but we do expect them to be pretty stable.
Fantastic. All right. At 7% after fees and taxes on returns, why would we say that the private credit fund would be better than a CD? And obviously, we know there's a myriad of different ways to invest, especially there's traditional stocks, bonds, CDs, money market funds. You've also seen other fractional platforms pop up. So perhaps, Cameron, we could pull in some of that as well.
Yep. So with CDs, those also tend to be shorter term instruments. So oftentimes a CD or a certificate of deposit will be 6 months, 3 months, 9 months, something less than 12 months often. And they're going to have rates competitive with high yield savings accounts. But like a high yield savings account, those rates are very much tied to the short term government rates. So as we expect inflation to come down over the next year or two, then those rates will continue to come down as well. Now, you may lock in a 9-month CD at a good rate of 5.3% or so, but then as the yields come down, those CDs will get repriced to be priced very closely to those short-term rates. So it is possible that they come down, whereas with the private credit fund, we do expect those yields to be fairly consistent.
Fantastic. All right, Ryan, we're going to get you back in the game here. Another one from Kevin. With a small minimum investment, do you expect investors to try to liquidate more often? And then how is the NAV calculated?
Yeah, it's a great question. So the minimum investment amount for anyone investing in the private credit fund, it starts at $100, and investors can really invest any amount of capital that they want. The reason for that minimum investment around is just to provide the most flexibility that we can. Investors may want to invest different amounts over different periods of time, maybe different amounts on a monthly basis or a larger amount in a lump sum. And the minimum investment amounts on Arrived are really just to provide that flexibility for investors. The liquidity program is, similar, designed to give investors the option to get liquidity on a quarterly basis. We think that that frequency and kind of shorter duration option for investors means that they can decide to invest maybe their medium-term cash or investments in something that's high yield, and have options to get liquidity if they need it, but also to let it continue to accrue dividends or reinvest over time if that's what they desire. So don't necessarily expect that the minimum investments correlate to the amount of requests for liquidity. I think that's really just based on individual investors and their investment objectives, and whether this is something that they're planning to invest and hold and let compound for the long term, or if this is something where they're looking to get some short-term returns and liquidity more frequently. So that's really what I think will mostly, drive the interest in liquidity. On the question around how is the NAV or share price calculated, it'll be calculated based on essentially the balance sheet of the fund. So the value of the cash or residential assets in the form of loans that they have is ultimately going to make up the net asset value and share price. The investment objective for the fund is to maintain a relatively consistent share price. So investors should really expect that the vast majority of their returns would come in the form of dividends, and we'll target those distributions or dividends to align to maintaining that consistent share price. So that's really what investors should expect.
Absolutely. Yeah. And I know I saw Alejandro, our COO, and one of our co-founders in the chat shared quite a few links to how liquidity operates and what that redemption program looks like. It's also outlined on the property page itself or the offering page. So feel free to take a look there as well for more details. All right. Moving back over to the chat here. Lots of great questions in the queue. This one is from Darren. Please explain the difference between first lien position versus first loan position and the advantages and disadvantage of these positions. Cameron, I'll kick this one over to you.
Yep. So they're going to be typically synonymous. So first lien versus first loan position typically refers to your status as a creditor. So in the event that a borrower is unable to pay some sort of obligation back, then being your first position secured creditor means that you have first rights to get paid back your amount that you lent out of all of the proceeds from a foreclosure sale. So this is primarily relevant when you get to the stage of getting foreclosed upon. Then all of the creditors potentially that would be out there would then get paid. Now, when to differentiate a little bit more, there are differences in lien positions, whether you are a debt investor or whether you are the government trying to collect property tax, or whether you're an HOA that the property is in. In some states, HOAs, for example, might have a super priority lien that because the HOA had already existed before any sort of debt had been put on a property, the HOA would have a superior claim and they would have to get paid back before even a first position creditor. So it is conceivable that there are other parties out there that would have a superior claim even above a first lien position holder as a creditor. But those are typically going to be smaller amounts. So you can imagine that property tax, HOA dues, those are all much smaller percentages compared to the amount that a creditor would lend for purchasing a property and then rehabbing it and then for a sale later. But more or less, the important thing is to be the first position secured creditor on the debt stack. And even a lot of times in instruments, you can't even take out a second position, or you have to get approval from the first position creditor for that. Typically not an issue with shorter term loans like we're investing in. but certainly it can get complicated quickly on longer horizon debt. So in practicality, not a huge difference between first lien position or first loan position, but all of the loans that we're purchasing are first position secured.
Fantastic. Yeah, great questions, Darren. Appreciate you walking through it in detail too, Cameron. All right, I didn't type fast enough in the chat, so I will come back to one of those. One moment here. Let's see. This one's from Kieran. Since the fund rate is tied to short-term interest rates, will it be impacted if the short-term rates come down? Ryan, I'll kick this one over to you. I'm sure Cameron will have some color there as well.
Yeah. So and I think Cameron answered this a moment ago a bit, but while the short-term rates are a guidance for any industry that operates around interest rates, the terms of the notes are governed by the note agreement. And so for the most part, right now we intend to enter into purchasing loans that have fixed interest rates. And so while those short-term rates are guidance for any lending market, it ultimately is just that. We do anticipate that if rates come down, that could mean that the market for these types of loans, the market rate changes. But at the same time, we've seen that the market rate for these types of loans is relatively robust and consistent over the years, because the overall interest rate is, a relatively reasonable part of the overall cost of completing a new home construction or new home renovation. So that's a little bit about, or kind of commentary on how we think short-term rates could impact. Cameron, I don't know if anything you'd like to add. Great.
Fantastic. All right, we'll keep trucking along here. There's one in here from Jim. What will be the balance between fix and flip and new construction? Cameron, I'll kick that one over to you.
Yeah, great question. Primarily, it'll be fix and flip, but there could be elements of new construction, such as the first loan that we're doing in Seattle. That one has the new construction of an accessory dwelling unit. It's a detached unit that provides an additional housing unit distinct from the primary unit. So most projects will be fix and flip, just kind of by nature of the demand for the type of lending. So a lot of borrowers, they'll see opportunistically that there's a house that is in kind of disrepair, and that they'll fix it up more quickly. And that's often the quickest thing to do. When you're getting into full ground up construction, sometimes those projects will be a little bit larger. So you may find a different type of financing. You could have longer term construction financing. You could have different warehouse programs that you would utilize for that. So I do anticipate that over time we'll be layering in more and more new construction, especially as we find repeat borrowers that we have a lot of confidence in. So some of the very professional ones that run large construction crews and have the ability to really secure it from all angles. I do think that we could layer in those at a higher percentage later. But in the beginning, we want to have a lot of, layups, let's call it, a lot of good projects where the land, the community, the value is already established. And it will bridge us from point A to point B quickly to earn the interest and, get repaid. So we'll mitigate risk that way. But I do foresee that over time, you'll have a slightly increasing percentage of new construction loans. As far as ballpark figures, a little bit hard to say. So the guidance that I give is more, how do we have good risk-adjusted returns? It's by starting off with those layups and then finding the high-quality borrowers and then getting some of those bigger projects in over time.
Awesome. Hopefully go for some slam dunks. All right, moving back over here. Let's see, one in here from Hassan. Can we see what the loan amount is and what the interest rate you are loaning to? Cameron, I'll kick that to you.
Yeah. So on the private credit fund page, you'll see some loan details such as the principal. So that'll be the loan amount on the project outstanding. We're constantly kind of iterating on the merchandising components of what we choose to expose on the credit fund page in terms of assets. Some of the information with underwriting is a little bit sensitive, such as like seeing credit scores and seeing people's underwriting. And if you were to look into the property address, you might be able to kind of reverse engineer your way into it. So we're being deliberate about exposing information over time. We're also, making sure that we have kind of the approval of our origination partners too, because they have the same concerns about just protecting the information of their borrowers. So right now, we're starting off at a high level view, but over time we'll have more and more granularity as our partners get more and more comfortable.
Absolutely. A good one in here from Jonathan, and you chatted through a little bit of this, Cameron, in prepared remarks when you're walking through the process. Why would we not cut out the originator and servicer to cut on fees and increased yield?
Yeah, it's a great question. And I think that over time, origination could be a possibility in the future. For right now, what we're really focused on is leveraging originators that have a really high quality program where they've seen thousands and thousands of loan repayment cycles and different borrower profiles and have gotten the underwriting down to kind of a science, right? So we're piggybacking off of that experience from those origination partners. Servicing tends to be a pretty low fee, high volume game. So to the extent that we could eventually service some of the loans, I think that's a distinct possibility. In the beginning, it doesn't really make sense to. And plus, a lot of the origination partners, they have internal servicing as well. It's also kind of a client service function where they want to make sure that they're not outsourcing their servicing to a third party. So in the event that there are issues, we can deal directly with the originator, who's also the servicer, and kind of have a one-stop shop for finding solutions to borrowers who are behind on payments or have to go through the foreclosure process. So there are some benefits to having origination and service partners that are not within Arrive, but certainly as the private credit fund grows and as we scale, it becomes a distinct possibility. And I think your remarks are completely valid. But we also see it as a kind of kickstart to leverage the experience of some of the other players in the field.
Absolutely. Cameron, you walked through this one a little bit. Ryan, I'm curious if you have color too. Steven's in the chat today, which is wonderful. Can you give info on originators what track records?
Yeah, so I guess without naming names, we've got a very small handful of partners that we've spent months doing due diligence with. So we've checked out their platform, checked out their servicing operations, history of their loans, some of the credit loss numbers that you may have seen on the details page as far as like what to accrue and what to expect. We've done that work with those partners. So I can say that, it's partners that we've worked before with as well. So, some of the 30-year fixed mortgages we've also done with one of our partners. So, they've been operating for, a decade plus on originating loans, both short-term and longer term, primarily all residential focus, so no commercial lending. Everybody is just really focused on value add residential and 30-year fixed mortgages. So we kind of stay within that ecosystem of residential specialists.
Fantastic. And there's a good one in here from Raj. Ryan, I'll kick this to you. Do you offer loans to mom and pop entrepreneur real estate investors?
Yeah, as Cameron mentioned, right now we're partnering with a few select origination partners. We're definitely interested in hearing from real estate investors what they like or dislike about working with some of the partners and see if there's any way that we can support them as well. We do have a web page where investors can submit their interest in requesting loans, and those will be provided to our origination partners as well. So we can share that in the chat. But ultimately, yeah, we're excited to support real estate investors, continue to partner with our origination partners, and ultimately, really kind of close the loop on letting investors access this asset class.
Absolutely. Yeah, very exciting. Another good one in here from Steven. Have you done any sort of sensitivity analysis as to what reasonable default levels would do to yields as some defaults likely? Cameron, I'll kick that to you.
Yeah. Great question. And certainly a part of due diligence and question you should be asking yourself. So with respect to defaults, historically, we've seen our originator partners, they say that there's about 1 to 2% of all loans will have to go into the foreclosure process where an exit, the borrower had not found the exit by the time the foreclosure process had happened. And, it's always a pain to go through a default and a foreclosure. However, I think we have to remember that this is secured by real property, right? It's not, and not only secured by real property, but then also doubly secured and guaranteed by the borrower themselves. So a lot of times the borrowers, they're going to be LLCs, but then the personal guarantee comes from often like a general partner or an equity holder of that LLC. And it's that credit score, that history that we're underwriting when we're purchasing those loans. So our partners have expressed that, and you'll typically recover about 80% or so of the full proceeds. So it's not just the principal amount, it's also the back interest that's owed, any sort of fees, any sort of other expenses that accrue during the default process, such as like serving process, right? Those are additional legal fees. All of that gets rolled into the full judgment amount that's owed, and about 80% of that is returned when you are going through the foreclosure process. So if you take 1 to 2% of all projects and loans that default, and then you recover about 80% of it, then that's placing us somewhere in the 20 to 40 basis point for the expected loss of principal for these loans. So we're hoping that we can outperform that. We're being very diligent about the originators, the borrowers, and the projects themselves. And I think it's also important to note that the numbers that I just articulated, that's from the originator perspective. So they're lending to everybody that qualifies. The Arrive Credit Fund is picking the ones we specifically like from those loan tapes. So that's why I'm hopeful and optimistic that, if we do our jobs well and if we're underwriting all three parties, projects and properties really well, then we'll be able to at least meet the expectations of that credit loss that we're underwriting for.
Fantastic. Awesome. And I know we've had some duplicate questions in here, so thanks for bearing with us. If you have a specific question, I want to be sure your voices are heard, so feel free to ping it in the chat. I will say behind the scenes, we have them teed up, so it's likely it's in the queue. We'll definitely ask folks to re-ask if we miss it. All right, moving back over, another one in here from Cam. If they have an LLC, can you still get recourse from the borrower? Cameron, I'll kick that to you.
Yes. So they are specifically signing borrower guarantees. So that is in the name of the individual. So part of our underwriting process is that when we are choosing which loans to purchase, we're also requiring that we see that the borrower guarantee exists, right? And just about every originator and loan that I've seen in this world, there is that personal guarantee from a named individual who has assets and a credit score that we've seen that is backing the project, even if the borrower is an LLC itself. An LLC can certainly, like, what you're entitled to is the assets of the LLC itself, but even beyond that, the borrower's personal guarantee to repay the loan, which if it doesn't get paid back, it could hurt their credit score as well.
Fantastic. All right. One in here from Todd. How would we compare the Arrive Private Credit Fund to Ground Floor? And what does that screening process look like? Cameron, I think we'll start with you, and then Ryan, if you have color here too as well on this one.
Yeah. So as far as how does the private credit fund compare to Ground Floor, I would say that the underlying loans and assets, it's very much the same world, right? Ground Floor is focused on residential bridge loans. They could be fix and flip, they could be new construction, they could just be bridging you from point A to point B until you have refinancing on a rental. Those are all specific residential use cases that Ground Floor specializes in, and it really is quite a pioneer in the retail facing market for these types of loans. So they're a great role model. As far as their screening process goes, I'm not privy to like the full underwriting of what they do, but I do know that they have credit scores, experience verification, that they have their standards on kind of risk adjusting the notes. So I would say it's very similar, and they're also a retail facing organization that has gone through very similar securities work so that they can offer it to the public at large. Rather than just say, accredited institutional investors. So that, they definitely put out a great product as well. And I think one thing to note is that this specifically is a fund, right? The Arrive Private Credit Fund is a single entity that holds a lot of different loans that the investors all get exposure to. On ground floor, I believe you have the option of purchasing individual loans, which currently that's not a product on Arrive. We aggregate them all into the credit fund. And I think they have some other ways of investing, some different mechanisms to get exposure to different loans. But Arrived Private Credit Fund specifically is an aggregation tool for all these types of loans, but more or less you're going to have the same underlying types of loans and economic profiles.
Fantastic. All right, Ryan, I'm glad you're back in the chat here. All right, moving over. I know we had quite a few of these. I want to just double down to clear any air here. So one in from Evan, you're getting individual guarantees to sign. If so, what type of due diligence do you do on the individual? Cameron, I'll kick that to you.
Yes. So individual guarantees are signed as part of the entire loan package. So when the originator is making that extension of credit, say to an LLC, it could be Development Company LLC, that is the borrower. Separately, there will be a John Smith that is personally guaranteeing the repayment of that loan on behalf of Development Company LLC. So when we're doing our due diligence on acquiring those loans, we're reviewing the originator's paperwork. So we look at their promissory note, the deed of trust or mortgage instrument, the credit profile, the asset profile, the prior experience. So we're privy to a lot of this information that the originators are providing to us because they have an incentive to want to recycle their capital because often they're in the business of originating money where they're getting the points. So it's kind of a velocity, what we call a velocity of capital business, where they want to recycle that capital quickly. Even for really great loans, their business model is not necessarily to hold them on their books, but rather to sell them to different institutional investors or different credit funds such as ourselves. And that's how they're making their money. So we get to review the packages for the borrowers, which is one nice advantage that as a retail investor, you may not always have access to, but kind of with Arrived as your proxy, we are doing that research up front.
Fantastic. And a good one in here from Gerald. What is the maximum loan to ARV that the fund will tolerate for a loan?
Yeah, so the general ballpark range is going to be about 70%. And just so everybody's up to speed on the terminology, loan to ARV, that stands for after repair value. So maybe you have a project that you purchase for $100,000, you put $40,000 into it in rehab money and expected to sell it for $200,000, for which there's an appraisal or at least a broker's price opinion that are going to be involved in each one of these loans. So we'll be typically lending 70% max of that after repair value. So potentially 140K to the extent that we agree that $200,000 is correct. Now, even if an assessor says, hey, it's $200,000, the Arrive team specializes in all things residential, including, valuation of properties, valuation based on income expectations. So if we're not in agreement with that $200,000 assessor, like we're verifying all of those values ourselves. And if we're thinking that assessor was off, we may not do the loan, even if it is within that 70%, because we're going to have our own opinions of value kind of organically within the org.
Fantastic. And I know we have quite a few questions around comparisons in here, so we'll throw this one on from Derek. An alternative to Arrive Private Credit Fund would be publicly traded REITs, real estate investment trusts, or BDCs. How is the fund better than publicly traded REITs or BDCs? Cameron, I know you walked through this a little bit. Ryan, I'd be curious your thoughts too. And as a reminder, this is not a research report or investment advice. So any information that we're sharing here is those of the presenter's opinions.
Yeah.
Yep. Well, actually, Ryan, why don't you go ahead and take first pass at it?
Sure. I'll just share one of my perspectives is really just the point of view around the residential housing market and creating a credit fund where the makeup of the assets are residential homes, which, as we talked about before, why we have such a strong belief in the robustness of the residential home market because of the undersupply, we feel like presents a great risk return profile for investors. And so that's really, I think, one of the unique features of the credit fund that we're putting together. And Cameron, if you want to, expand on that, any other thoughts?
Yeah, so I think publicly traded REITs, they have a big difference with what Arrived offers in its funds, and that word is publicly. So a lot of times when you're investing in those shares, you are buying exposure to the underlying economics of those real estate investments and those assets, but you're also getting a really healthy dose of public exposure for better or worse. So whether you are investing in NASDAQ, commodities, Dow Jones, public markets often have very highly correlated movement, right? So you're getting access to those assets, but you're also, if you already have a lot of stocks, when you're purchasing publicly traded REITs, you're getting even more exposure to public markets, which may be an unintended consequence. So the Arrive Private Credit Fund is pure exposure to the actual real estate loans and assets themselves. So whether you're in the SFR fund, which is our equity positions for rental properties, or you're in the Arrive Private Credit Fund, it's all exposure to the underlying economics of real estate without the noise and just the large scale impacts of publicly traded vehicles. And there's also typically a public a liquidity premium is what it's called, by virtue of being a publicly traded instrument. Yields will often be a little bit more depressed because there is an embedded cost that people price in for being able to sell it on the day that they want liquidity, whether regardless of the price, they are able to sell it. So publicly traded investments will have slightly lower yields because of that feature. But those are, it's not necessarily that it's better or worse, but it's just a different type of return than getting pure real estate exposure.
Fantastic. Yeah, great questions, Derek. Appreciate you asking. And patience, I know you had that one a few times in the queue. All right. I know we're getting to the top of the hour. We have quite a few questions left. Ryan and Cameron, hard stop. Are you comfortable chucking through the questions? All right, we'll keep going. Absolutely fantastic. This one's from Steven. Do you have your own appraiser determine the completed value for loan to value? Cameron, I'll kick it to you.
Yep. So with every loan origination, the originator does get an appraisal, and this is very common within any sort of debt. So whether it's a 30-year fixed mortgage or if it's a short-term residential loan, an appraiser will typically be going out there to give their own assessment of the property as well as an after repair value. So they give a couple different values. There's what is the initial value, just as is condition, and then more importantly, what is the after repair value based on what the developer wants to do. So we consume that information. But as I mentioned earlier, we have a lot of great investment professionals in the residential space on our team. So we're looking at each one of those individually as well. So it's kind of a two-step process. First, what does the third-party appraiser say? And then second, do we agree, disagree, and then go from there.
Fantastic. And Kevin, I know we have quite a few Kevins in here, but thanks for joining today. We'll be sure to send the recording out to all registrants, and so appreciate the fantastic questions. All right, moving back over private credit. Private real estate credit is not a new market. What is Arrive's strategy? How do you think you are differentiating yourself? This is a great one. I think it's going to be a combo question. Ryan, do you want to kick us off? And then if Cameron has any color.
Sure. Yeah, I think there's a few components here. And when we think about private real estate credit, there's a ton of real estate assets. It could be residential, like single family homes where we participate, or it could be financing for large apartment buildings, office buildings, industrial warehouses. The private credit market is vast. I think we shared earlier why we have a really strong belief in the residential market, and why we think that that's a great place to participate. And then the other reason is that while private credit has been around for a long time and has been really growing quickly right now in the market, the access to private credit has not been as easy for investors. Things like high minimum investment amounts, typically starting in the six figures, sometimes much larger. And also not really being able to control the type of asset that is backing the credit investments is really one of the things that we wanted to support as well. So I think the combination of flexible investment amounts, access to really strong risk-adjusted yields and returns for investors, and then really being residential single-family home assets is what we really have been excited about.
Yeah, and to add on to that, in terms of the loan acquisition process and just how are we differentiating ourselves as a credit fund, I think one of the differences between what we do here at Arrive versus what other lenders or originators or other funds have put together is that we're really invested in um, understanding all aspects of the residential market. We have plenty of experience on the equity side, the ownership side, right? We have a portfolio of rentals that we're trying to optimize the end outcome, in a 5 to 7 year horizon. Lenders can, and just the business of origination can often be very much just a financial exercise, right? There's kind of some best practices out there. There's some general rules of thumb that people follow, and they seek to, a lot of those lenders, they seek to get the cheapest capital possible, lend at the highest rate, and control default rates. But it's kind of an academic financial exercise for them. At Arrive, we take the position of trying to be right about where real estate growth is going to occur. So a lot of the competencies we've developed as a team are about understanding the rental markets, understanding the pricing of assets, understanding all of the risk profiles and where the spectrum of outcomes are going to be. So, it's kind of a long way to say that we're hoping to perform out on the risk adjusted returns, because unlike an originator that's following kind of a menu and, a matrix of underwriting criteria, we're taking that, analyzing all that information, and really taking it from a real estate investor long-term perspective. So even though these are shorter term loans themselves, our team is really focused on understanding short, medium, and long-term performance. So we're hoping to outperform some of the industry norms on, say, credit loss, right? Because by picking the right borrowers, the right assets, then we would have higher expectations of getting paid back on a higher on a better frequency. So that's what I would say is how we're trying to differentiate ourselves, is that we're really a real estate residential operating company, not just a financial underwriter.
Fantastic. All right. A good one in here from Larry. Ryan, I'm going to kick this one to you. If the borrower declares bankruptcy, is any money from the investors lost?
Yeah, it's a great question. Really around what happens if someone defaults on a loan. The reality is that before any sort of bankruptcy or something like that, a loan would go into a default when a borrower missed a payment. And what happens when a borrower misses a payment is that the interest that they're paying goes up. There's an incentive for them to, catch up, get out of default, because while in default, they're accruing interest at a higher rate. There's another major reason why they're interested in curing default, which is that these investors typically have significant amounts of capital, of their own capital, also invested in the outcome of this property. And so they're really not wanting to go through any sort of foreclosure or bankruptcy process where they lose the property goes through some sort of short sale process where the lender, in our case, let's say, is going to be made whole as long as the property can be sold for 70% of the value of the property. And that's assuming a max loan to value lending scenario. Oftentimes the loan to value or loan to after repair value might be more like 50%. And so there's strong incentives in the process for the borrower to cure a default. If they aren't able to cure a default, then that loan would essentially go through foreclosure, and the lender would ultimately foreclose on the home and take possession of the asset, and then have the option to sell that asset. And so that's a little bit about what that process looks like. A scenario where an investor might lose money is if there's a default on a loan, the lender, Arrived in this case, takes possession of the property and sells the property for less than the loan value. And that would be, the likelihood that an investor would, let's say they've lent 70% of the value of a property. That means that that property would need to be sold for a 30% less value before an investor loses the first dollar on that note. And that's one of the benefits, I think, of investing in real estate backed debt, is that there's that margin of protection in that loan to value or loan to after repair value for investors.
And to put it in perspective of kind of would investors lose money in the sense of like, would the share value go down? Would they experience principal loss for their shares? Now, certainly you could have principal loss on any single loan itself. So if we go back to the example that we were talking about with an 80% recovery rate, just for simple numbers, let's say that they borrowed $100,000. We had to go through the foreclosure process and the credit fund got paid back $80,000 net proceeds. So it may seem like it's a loss, but you have to remember that it's also one of many loans out there. And if we're paying out, say, 8% on average into the credit fund, and then we experience what we, let's say the underwritten credit loss amount of 0.4%, then it's as if the yield, instead of being 8%, was really 7.6%. So, we can think about the loss on one individual note, but if we think about the loss of investor principal in the shares of the credit fund, there's not really loss until it falls even below the amount of interest we're earning, because we're getting yield every single year. So let's say after 2 years, there's 8% each year. So, you started with $100 and you have still that $100 of principal plus $16 of interest. But there's been, a couple of defaults where you lost 40 cents, 0.4%. So that's kind of how we think about the credit loss numbers. And why we like debt so much is that it has a high yield. It has that secured, that security of the real estate, the repayment of that. So when you net everything out, you earn a little bit less interest than the headline amount, but principal is quite protected from a share value point of view.
Fantastic. Yeah, great questions. Good one in here from Michael. Cameron, you briefly talked about this earlier when there was another question about reducing fees if we restructured it. Is Arrived ever going to be the borrower that the private credit fund lends to?
Yep, it's a possibility to the extent that Arrived starts becoming a flipper themselves, or if we get into development projects ourselves and to finance the projects. Certainly, we might be able to tap into the Arrived investor community. But until we get into those types of projects, we wouldn't be a direct borrower from the Arrived Private Credit Fund.
Wonderful. A good one in here from Stephen. This could be a combo question too. Do you get higher rates from weaker borrowers? Will you limit how much you lend to a weaker or less experienced investor?
Yeah, the intuition is correct that in general, borrowers that have demonstrated less experience or maybe have more financial risk by having less assets or a lower credit score, they would typically have a higher interest rate compared to a more experienced developer. If you're looking apples to apples on a project, an originator should give a better rate to a borrower with more experience. So there's kind of two components that an originator is going to underwrite to. One is exactly what you're hitting on, the strength of the borrower, and the second is the specifics of the project. So how much money do you want to borrow relative to the assessed values, both in an as is and an after repair value state. So the more that you want to borrow against it, the higher the rate is going to be, because the perceived risk of that project is increased. But similarly, if you are a weaker borrower, that does also increase the risk of the project. So we definitely skew more towards borrowers with a higher amount of experience. And that's not to say that we would never lend to less experienced investors, because sometimes you may have less projects in a certain period of time because each project that you're doing is larger and takes longer, like with new construction. And those are challenging projects. So if people are able to successfully pull them off and execute it and sell it for profit, that's a great sign, even if the volume is a little bit lower than somebody who's doing a lot of 90-day smaller flips. So it just depends on the kind of the type of project that the borrower is doing, but your intuition is absolutely correct, and we would seek to limit the amount of inexperience that we have within the credit fund.
Absolutely. Yeah. Great questions as always, Stephen. Moving back over to the queue. Robert, I know you asked, when is the fund opening? It's live now, so feel free to jump in. You can invest at any time. I'll also drop a link for easy access, so you have this on your end. All right, moving back to the queue, Ryan, I'm going to kick this next one over to you. I love this one. It's from Derek. Let's see here. For the fund, how much capital is Arrived insiders or employees or teammates putting in, asking to see how aligned Arrived employees are with investors?
Yeah, this is something we've been excited about for Arrive team members from the early start of Arrive to begin with. And we wanted to make sure that Arrive team members also had the opportunity to invest alongside investors on Arrived and to encourage that. So actually all Arrive team members have a monthly stipend to invest in offerings as part of their employee compensation package. So that's part of, all of our team members' overall compensation, and team members are often investing, beyond that in offerings on Arrived as well. And they're investing across all of our offerings, individual properties, the single family home fund, and the private credit fund.
Fantastic. I always love that question on inlined incentives. I know you'll see Sue Korn, our Arrive CFO. We have Alexa in there, our VP of products, and quite a few other folks, and myself included, that have invested and believe in what we're doing. I think it's one of the reasons we've been able to build for and by our investors, because we believe in what we're investing in and walking alongside you all. So definitely appreciate you walking through it, Ryan. A good one in here from John. What is some risk that y'all perceive as foreseeable? I'll kick this one over to you, Cam.
Yeah. So as far as foreseeable risks, I think that any project that is being done always carries a fair amount of risk, because dealing in the physical world is always challenging. There is a short amount of labor, generally speaking, out there with respect to trade labors. There is rising material costs. Commodity prices are volatile. So, certainly I think that construction itself is a risk in of itself. I think that we seek to mitigate this because one of our ways that we look at loans that we like is we first like to look at a lower percentage of rehab as part of the total loan. So we like more of the principal that we're lending to be tied up into the as is value of the land and structure itself. So it eliminates some of the dependency on a borrower being able to perform. But that's not to say you eliminate all of that risk, nor should you. In fact, you want some of that that higher construction amounts with really experienced borrowers. So that's kind of how we dial in on where do we allocate which loans we're purchasing. It's, well, we're willing to go higher on renovation amounts with the more experience that you have, and the less experience you have, we index more strongly to, did you get a good buy? We want to make sure that we're not lending too much kind of against the borrower's ability to transform and perform value add, but more so, did they get a good piece of land, a good structure in a good neighborhood? So I think that just operating in the physical world is some of that risk. And of course, there's a lot of macro risk as well. Changing interest rate environment, housing market has been somewhat volatile over the last couple of years, mostly to the positive direction. But any sort of asset does present its own challenges and sensitivities to, say, interest rates or inflation or a recession in the economy. So those are some of the things that we can anticipate, and I think that we're not completely out of the woods yet. America in general could still experience a recession in the short term, but that's also why it's really important to have good underwriting of the correct borrowers that can repay, even in these types of scenarios where the projects don't pan out or the weather very quickly changes on them in terms of their ability to exit those opportunities. As long as they're backed by enough assets and experience, they're generally going to be able to repay back. And that's the first layer of protection. The second layer of protection being like, is this property a really great property that is going to be able to be exited? So, all the normal risks that you would anticipate exist, but it's really maybe the more important question is, how does Arrive mitigate those? And that's what we're planning for.
Absolutely. Yeah. Appreciate you walking through that, Cameron. It looks like we have 6 questions left in the queue before we shut our virtual doors. This one is from Dawn. I'm going to kick it over to you, Ryan. Is the private credit fund a one-time event, or does it have a ceiling?
Yeah, so the private credit fund will continue to be available for ongoing investment. on a regular basis, and really to give investors the opportunity to either invest on a recurring basis. Maybe they have an allocation, they want to invest in the fund on, let's say, a weekly or monthly basis, or if they want to do a larger lump sum, they can do that as well. That also means that the fund will continue to add new assets. So as investors invest in the fund, we'll continue to acquire new loans, continue to diversify across the portfolio, across the markets that we're in. And so we'll continue to grow the fund. The anticipated size is that we'll raise up to $75 million on a rolling 12-month basis. So the fund can grow beyond that, but there are some limitations from the SEC in terms of how much capital can invest in a rolling 12-month period. And so that's really what the size of the fund could target over time. Yeah, I think that's I think I got through everything.
Yeah, very exciting. One thing I know you all have mentioned too, like yields like these are typically only available to in the know accredited investors that have high minimums of 25K to 250K. You can get started with as little as $100 and invest on whatever cadence makes sense for you financially, and depending on your risk tolerance. So keep that in mind. I will say too, I saw some feedback in here about auto investing. So we don't yet have that, but you shared it with the absolute perfect people on the webinar today, Alexa, our VP of product, as well as the rest of the team. So we're hoping to offer that in the future. But as it stands today, you can invest on whatever cadence works for you. There will be an option to also reinvest your dividends once they're available in your cash balance. So you can do that whatever time you would like. All right, moving back over. I think we have a few more in here. All right. This one's from Evan. Are bridge loans superior to construction and or mechanical liens that would be filed by the subcontractors and or the general contractor? I'll kick this one over to you, Cameron.
Yep, sure. So mechanics liens it's going to be dependent upon state law, but typically they do have a fast path to being superior to any sort of recorded loan that already exists. So they're going to any sort of GC or subcontractor to get a lien perfected on the title. They're going to have to go through a lot of the same processes to, file a judgment, get it approved, and then file with the county recorder to actually show the mechanics lien. And it can supersede a creditor's position on it, but they're, again, typically going to be smaller in amounts. And it's very necessary for these types of laws to exist because you want to protect the workers and kind of incentivize people to do work. We want to make sure that we continue to live in a society that has, enforced laws and high trust such that people are willing to do the work. And the superiority of a mechanics lien is one of those mechanisms that really do help with that, to make sure that people can work with confidence and then improve things. But compared to the size of a residential bridge loan, they're typically going to be small on those mechanics liens. But certainly we're on the lookout for that and work with our originator partners. And to one of the points I had earlier about your servicing plus your originator kind of lumped into one organization, it really helps us keep track of the borrower's progress to make sure that the construction project is going as according to plan, that if any liens do come up, like we can immediately see them because the originator is working closely with the borrower as the servicer as well. So again, depending on state law, to my knowledge, most states do give superiority to mechanics liens, which could be synonymous with maybe what you're saying, construction liens. But to maybe just make one clarifying distinction, we've also got construction loans kind of wrapped up in the residential bridge loan. So when we lend out money, let's say, the borrower is borrowing $200,000 in full, $150,000 of that may be for the purchase of the property. So, like a purchase money portion. And then they have maybe two scheduled draws of $25,000 each to reach their milestones. So the process, the way that this works is that the borrower is performing that work, and then they have to prove that work was performed, and then they get reimbursed by the lender. So that first $25,000 draw will come out, and then that's how we're keeping track of that. So there are kind of some protections in place where we're also making those construction loans and keeping track of that money, but the borrower is typically fronting that and then getting repaid back once they show evidence of that progress being made.
Fantastic. And it looks like we have quite a few folks looking to invest in the private credit fund right now. So if it is a little bit delayed for you, feel free to use the chat function in the bottom right-hand corner of our platform. It's just taking a little extra time there. So let us know if you run into any blockers, and we're happy to work with you one-on-one. All right, moving back over, I think 4 or so questions. One from Rory: if the house goes into foreclosure, how much longer will it take for the loan to be refunded? As to the normal loan period of 6 to 12 months. Cameron, I'll kick that to you.
Yeah, great question. And let's start with at the time when a missed payment happens, because whether it takes longer than 6 or 12 months, it depends when the default would happen. So here are some kind of milestone periods in kind of the loan repayment process. So let's say at time 0, a payment is due and then it's missed. Interest is paid in arrears, and there'll be typically like a 5 to 10 day grace period where the borrower has that extra time to make that interest payment before a late penalty kicks in. So basically, for the first 30 days, you're either collecting that interest payment or you're trying to collect that interest payment, and then different fees can stack depending on how late they are. Then after days 30 to 60, that's when you start getting more serious about going into the foreclosure process by initiating the process of serving notice. So you're basically starting the clock according to state law to say, I am putting you on notice that you are in default on your promissory note. And then the security instrument would then allow us to start serving that process and going through the foreclosure process to put it into effect. Past day 60 is when you're really going through the actual steps of making filings with the county recorder to say, we're putting everybody on notice that this is in default. And then at that point, there's kind of 2 different processes that could happen depending on the state that you're in. There are 2 ways of foreclosing, and it's according to state law. It could be a judicial foreclosure or a non-judicial foreclosure. So states that have a judicial foreclosure requirement require that you file basically with the court system to get your judgment approved so that you can foreclose. Those can take a little bit longer because you are subject to the kind of traffic jams that may occur within the legal system for that county. In non-judicial foreclosure states, you have an instrument, a security instrument that is typically called a deed of trust. And that deed of trust will have a clause in there called a power of sale clause. That power of sale clause allows the trustee of that instrument, that security instrument, to initiate the foreclosure process without having to go through the court. So, the short answer then to how long does it take is, you go through about 60 days of really trying to collect payments, serving notice, and trying to get the borrower back on track. Past those 60 days, you really start initiating the legal process to take the property back and then sell it at foreclosure sale. It's much quicker typically with the non-judicial foreclosure states. So, starting at day 60, it might take 2 to 3 weeks for the trustee to do everything that person needs to do to kind of affect the sale, get on the schedule. For judicial foreclosure, really depends on the court system itself, but I would expect at least a couple months before it gets on the docket to be sold at the foreclosure sale. And any time in between that, you can usually cure. So you want the borrower to come current on their payments and to, kind of pull a 0.5 3-point shot and be able to pay you back. Doesn't always happen, but up until the foreclosure sale, typically the borrower can pay you back.
Awesome. I got stuck on mute over here. I appreciate you walking through it, Cameron. I'm going to push this one over to you, Ryan. Obviously, we've had tremendous growth. We sold shares in our first 6 rental properties in March of 2021. We now have roughly almost 400 single-family residential properties. 39 vacation rentals. We have the single family residential fund, now the private credit fund. Rose is asking, is Arrived offering too many products too soon? And is that interfering with finding and making available single family residential properties available? It's a great question.
Yeah, it's a great question. And I think in general, we've really tried to build an investments team and structure with which Cameron can probably speak more to, that can be flexible based on the investment opportunities that we think investors really want to participate in and that we think are the most attractive at any given point in time. When you think about the investments that we've made into individual single family homes, single family home vacation rentals, the single family home fund, and now the private credit fund, a lot of the underlying assets are very similar residential homes. And that means that the process of going through and acquiring these assets, so doing the underwriting, doing the analysis of what specific markets across the country that we think either have the best potential for growth or the most robust demand and supply balance due to population growth and interest in that market. A lot of those underlying items are really the same across these different assets. And then the team involved in making those decisions, acquiring these assets, and then managing our partners, whether those partners are property managers or loan servicing partners, is also relatively the same, or at least there's a lot of commonality between them. And then the last item of making these investment opportunities available for investors is really the securitization process with the SEC and registering or filing these offerings so that anyone can be able to participate. And we've really built a robust process for registering or filing these offerings and making sure that we can make them available as individual properties or in our different funds. And so that's really what we've been designing and building for investors, really to make sure that we have investment opportunities that we believe in available at any given time for folks to participate in.
Absolutely. Yeah, Rose, so appreciate the question. I saw Brett, our head of branding content, also shared a link to all of our circulars to take a look at. But we so appreciate it when you're asking like level of priority and what it looks like when we're expanding in the future. All right, moving back over here. Cameron, I'm going to kick this one to you, and then we have 2 more questions before we shut our virtual doors. In terms of risk management, do you have any internal policies or guidelines in place, such as limiting the portfolio to a max of 10% in any single state, or ensuring any single borrower doesn't represent more than 2% of the portfolio?
Yep. It's a great question, Gerald, and we definitely consider all the things that you had mentioned. We also have an investment committee that meets on a weekly basis to go over the portfolio. It's hard to say what exactly the limits should be from a policy perspective, and it's an evolving kind of policy that we have. But to give you a little bit of context, using the SFR fund, we have over or close to about 20 markets in the SFR fund across all of our properties. And there's no single market that represents more than, I think, 12%. I think Fayetteville, Arkansas is about our highest representation within the SFR fund across the 15 million or so of assets that we have in there. So we're pretty diligent about monitoring this on a weekly basis. I would say that it'll continue to evolve, but all of the things that you're mentioning as far as exposure to a geography, exposure to a borrower, are very much within the reporting packages that we put together when we're looking at these things on a weekly basis. So just know that we do have the goals of diversification, preventing overexposure to any one particular segment. Like, we wouldn't want to go too heavy on new construction early, and to your point, we wouldn't want to have any single borrower represent an outsized percentage. So those are kind of living, breathing policies that we're meeting with on a weekly basis. And I'm sure over time we'll have better reporting that'll articulate these to the investment community as well. So you can see kind of the layout of, what is the portfolio allocation and what is the borrower distribution.
Fantastic. All right. One more question here before we shut our doors. Virtual doors, we're always accessible, but webinar today. Are the payments from borrower equal, or do you allow ramp structures and balloon payments? Cameron, I'll kick that to you.
Yep. So the loans are interest only. Haven't really seen an amortizing residential bridge loan before. So these are interest only payments that will typically be due in anywhere from 6 to 24 months. So there's not really a ramp structure. Sometimes these are structured as balloon payments, kind of for state law reasons. You may see the structure sometimes as a 42, where there's a 40-year amortizing schedule and it's a 2-year balloon payment, but it's effectively an interest only loan. But you can expect that these will be fixed payments, interest only, with the full repayment of the principal occurring at the end.
Fantastic. And it looks like we cruised through most of the questions here today. We'll also be sure to send out recording. Looks like we have one last one in here from Martin. Cameron, in the case of a default, will Arrive be responsible to collect from promissory person, or will Arrive outsource?
Yep. So we're going to work with third-party counsel and the originators who kind of own that borrower relationship to go through the process. All of the originators that we work with, they have internal teams that are focused on the administration and repayment back of the loans. So to the extent that we have to go further into the default process and then eventually foreclose, we work with those originators teams and then outsource the actual legal, administrative, and recording to third parties in those markets, because it becomes very specific in terms of the process you have to follow. So you definitely want to use local counsel to make sure all of the administrative details are correct, to not hold up or delay the foreclosure process.
Fantastic. And Ryan, there's always a big compliment in the chat, and I feel like it's a good one to end on about who we're building for. This one's from Raj. Is Arrive going public, and when?
Yeah, no, we really appreciate the support from investors. We don't have plans right now to go public for Arrive, the operating company, but of course that is a possibility in the future. In the past, we have allowed investors on the Arrive platform to participate in equity investing in the company as well. We just in our Series A financing, where we raised $25 million from outside investors, we also held a portion open for investors on the Arrive platform to participate, and we hope to be able to support that more in the future.
Fantastic. Yeah, it's always a huge compliment. Like Ryan said, we're hyper focused on building for and by each and every investor that we have on our platform, as well as folks that are learning as well. So thank you all for spending an hour and 35 with us. Absolutely exceptional. Cameron and Ryan, for your prepared remarks, walking through all the questions in chat. And then a huge kudos also to our team. You saw a myriad of different team members answering all sorts of questions. So definitely appreciate you all. Ryan, Cameron, any closing thoughts before we shut our virtual doors?
Oh, first, just want to really thank everyone for your time and attendance and all the great questions. Really excited about this product. It's one that's near and dear to my heart. Used to have a hard money lending and residential credit company in Las Vegas, and I'm a strong believer in the investment class. I think it does a lot of good for society to help developers improve the real estate. We're definitely in an undersupplied market, so really part of the mission of Arrive to be able to add the supply and kind of not only provide great investments, but help solve the housing issues that our country faces. So super excited about this.
Yeah. Well, thanks everyone again for joining. Corinne, thanks for leading the charge and discussion today. And Cameron, thanks for leading the Q&A. A ton of incredible questions from everyone. So thank you for submitting those. And thanks to the Arrive team that joined in chat to help us answer questions live. Thanks everyone. And we'll see you all again soon.
Absolutely. And as a reminder, private credit fund is open right now. It looks like 1.5 million invested so far. So thank you for being part of a historic day and walking alongside us. Hope you have a great rest of your day, and we'll chat soon. Happy investing.